Good to see you guys again.
Good to
Been
see
a
you guys.
wild, wild couple of weeks since we last talked. Quickly go through our intro, just for those of you that are joining for the first time. So, welcome to today's webinar. It's called The Tipping Point. Is Bitcoin building for the next expansion or breaking down? My name is Yann Allemann, and I'm joined by Willy and Henrik Zeberg. Just a quick disclaimer before we start. Before we begin, please note that this webinar does not constitute financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is intended for educational and discussion purposes only. This session will be about 45 minutes, maximum an hour, of which hopefully 30 minutes we can allocate for Q&A. So, with no further ado, where do we stand, guys? Is this the beginning of the end of the beginning?
And the $1 trillion question.
$1 trillion question, exactly. What do you think, Henrik?
No, it's not. There's simply too many things that wouldn't add up. Um, Again, like I said in 2022, as I said also in April, and before that, there are things that needs to fall in sequence. There are things that needs to happen, and if they don't, then it's because it's not the top. So it's like there's if you go to an opera, I haven't been to many in my life, but there are certain things that needs to happen at the end. As we say, the fat lady needs to sing. And I just don't see that. And there's different things. You can say, for instance, that the fact that Bitcoin should then have put in a top, I think, in August, right? And then we have seen that risk asset else, stocks and so on, and also across in other countries, should have continued higher onto November. Nah, it's not how it works. And we'll see a lot of, now we start to see SEC and other small stocks, sorry, small cryptos, altcoins are starting to move higher. Would that have been the situation? Probably not. Not if the top was in Bitcoin was in August, and then you see September, October, November, and then now we start to see it. No, that's not how it works. If you look at the Bitcoin dominance index, we have had a two-year long almost divergence into that top we had in, let me think, April or June. And now it should already have been over, because if we have a massive top in Bitcoin, then we should see the rest of the things starting to crash here. The dollar is another thing, the equities itself, and so on and so forth. So if you look at all of that across, again, there's no guarantees, but what we can always do is that we can look at all these pieces here and then say, as I always say, who's the murderer here? Is that the butler because of, and then we kind of list the things up. And I simply see there are too many things that doesn't add up. And yeah, I mentioned a few of them here. So no, there's no way. This is the beginning of this massive rally that people will fall all into. And when we are at the other end of that, nobody will hear me say, a lot of people will hear me say that it's the top, but nobody will like it and will tell me how foolish I am. So I think sentiment is also all wrong with this. So no, it's not the top. It's the beginning of a very strong rally as I see it.
Maybe I'll chime in. I think the most important thing in assessing are we at the top is timing. Obviously, it's like most people look at how high the price has gone, but I think it's more structurally where we are in the bull market and how much time left we have in it. And so really it just comes down to how much time we've got left. I've been thinking that Q4 2025, which we're in now, we've got what, 8 weeks left, end of this year. Typically that's been tops for every single Bitcoin bull market. If we've got work to that, and even if you run technical analysis across timing signatures on things like stocks, we're coming up to a same timing signal of the end of this quarter is a reversal on the trend. And so if I work with that, and then my work is to measure the liquidity in Bitcoin, it's not in great shape, right? Like the liquidity that powered Bitcoin to the top of, let's say, just over 100,000, tail end of last year, beginning of this year, we had that sort of consolidation, and we powered through to as high as 120, 125, right? That second pump was followed through by insufficient liquidity meaning that this high that we've had at 120K is invalidated by liquidity flows, and therefore it was driven by momentum more than fundamentals. So what we've created here is a bearish divergence in liquidity, where the higher price of 120 is not really justified. Now we can measure that, and the liquidity now is sort of bottoming out, and it's showing signs of a recovery. The leading signal is climbing, the trailing signal is still dropping. So we're looking at a reversal situation here if that trend continues. It has been for the last week. So we can expect, if this continues, a price recovery. Typically, it takes 2 weeks from this liquidity signature to actual for price to start responding. And so that gives us now 6 weeks left. And I just do not think we've got 6 weeks left to stage, a rally to new highs. So it looks to me like within Bitcoin, we may get a double top, we may get a relief rally, we might even go slightly higher into a bearish divergence and reject it downwards, and that would close off the year. If the thesis of that this is the end of the bull market for Bitcoin ends in December 31st or beforehand. So if it runs on to January, then there's plenty of time for liquidity to come back in. Still not great shape because you don't usually see a bearish divergence on liquidity. You usually see each liquidity injection being larger than the last. Once you see the next one being smaller, it's a warning sign, and we've had that. Structurally within the flows, we've got altcoins continually to drain. They're in a bearish liquidity situation. Never mind what the price is doing. This is a little more broader time frames over 6 months or more. Whereas the liquidity in Bitcoin it's not really turning just yet to a bearish stance. So it's kind of a little bit of hope in there. If it turns, then money's draining out of the system, and that's not a good sign. So right now I'm most bearish out of the three of us here. I think it's really about how much time there is, and how do I relate that to global macro and stocks. Bitcoin is not like stock markets. It's not like gold. And what I mean by that is these markets are mature. Stock markets are like 500 years old. Gold is 6,000 years old. These markets have got over a century of development in them to modern day, where the liquidity is very, very broadly distributed amongst participants. The liquidity in Bitcoin is nascent. It's dominated by whales. Huge amounts of it is still developing. Retail's coming in a bit, institutions coming in. But what it means is the liquidity dynamics of the whales dictate what's happening. And if they're selling, it doesn't matter what's happening with stocks, and that can completely hold down Bitcoin's price while we get a blow off top, which I think, obviously Henrik is right that he's been calling this blow off top for months and months, even while we're in the pits of hell and everyone thought it was bearish as he will go to a blow off top. And that is happening right now. I'm just not seeing the liquidity inside Bitcoin respond accordingly. We're talking about trading correlations of the past. Usually everything trades in correlation. This time it is in correlation in the short time frames. You'll see the hourly candles move, and Bitcoin's hourly candles move in conjunction. But when we're talking about these flows, there's a different story. And so we're not seeing the blow off top just yet. And I think a relief rally, 75% chance we'll get a relief rally, and structurally we don't go much higher than the all-time high already, unless we get more time in the bull market, which means into January, into February.
Yeah, I think that makes a lot of sense. I'm probably between all of us more in the middle, because I tend to not want to give any sort of time prediction, or because I think these things are just inherently complex, right? But what is interesting, and I'll pose this in maybe two questions so that we can have a little bit of a debate here. What's interesting is that what makes this cycle different from previous cycles that you and I have gone through, Willy, since let's say the early 2015, 2014 type of environment, is that it's been extremely Bitcoin dominant for the pervasive part of that cycle, right? Something that we haven't seen as much in other periods, right? Because of the fact that it was a nascent asset, because of the fact that a lot of the institutional plumbing, let's say that the sophisticated products that you could trade on it were not non-existent, that are now present. It has created a different type of situation, right? Where Bitcoin has gone on for longer in a much more significant way, even more significant than I would have guessed towards the end of last year. I thought that Bitcoin would actually start taking a backseat versus Ethereum and Solana, something that eventually happened, but closer towards, let's say, the second half of this year, right? Let's say June, July area. And everything else has been suppressed because of it, because of the fact that Bitcoin has been so dominant, because of the fact that all the flows went into Bitcoin for a persistent period of time, that maybe everything else versus Bitcoin has been suppressed to such a level where the selling has been going on for that entire time period, where now the marginal seller that is coming through on the Bitcoin side is actually has kind of exited left of stage in Ethereum, Solana, and some of these other places. I'm talking specifically probably Ethereum, right? Where now there is much more of an opportunity cost to get to that all-time high with things that are not Bitcoin because of those shifting dynamics on one end. And you are right to say that Bitcoin at the end of the day trades differently to other assets because of the fact that you have a lot of a high basic concentration of few players that hold disproportionate amounts of actual tokens. And obviously things will get suppressed. I mean, I think there was that theory now of the IPO, right? Bitcoin's IPO moment. We've been talking about this for probably 2 to 3 years now, about the change of the guard, right? The old becoming basically that was trading in their early 20s, right? That were very risk. They were willing to basically ingest a lot of risk, to be early movers, early adopters, that are now maybe in their mid 30s, late 30s, maybe even mid 40s on average, that have families. They want a more risk adjusted lifestyle, right? And they want to diversify out of Bitcoin. And maybe what we're seeing now is that transition that has been going on for longer, because on the other side, there's the institutional wave that is coming in, that is actually absorbing the marginal buyer, that is absorbing, let's say, this excess liquidity. But at the same time is also starting to be interested in the diversification potential of looking at Ethereum, in your words, Willy, as an actual technology play, right? And not just let's say a pristine collateral play, right? Or a digital gold, right? Which is kind of the pervasive narrative that exists. And that opens up the can of worms in a way, right? In the terms of, in a way where it's not clear where we actually step, right? What's very clear is that this is becoming macro asset, and the kind of the normal, thumb in the air 4-year cycle, this is where it ends, is not really giving you all the answers that you need, because I think it is more complex. There is more to this than just the intrinsic cycle that has been dominating crypto for the last, let's say, the better half of the last 10 years. So the question being, is the lack of liquidity on the Bitcoin side opening the door to more upside and more intense upside as everything else catches up? And as an extension also to maybe Henrik, where do we see equities going from here? Because it seems like what we saw yesterday and today is a rotation out of some of the larger stocks or names like Nvidia. We saw today that it was down 5%. I haven't checked over the last hour or so, but around 5%. I mean, that's significant. $5 trillion asset class that is down 5% in a day. It's pretty significant. But where does that leave us, right? Is this kind of the end of the beginning? In terms of, the beginning of the end, so to say, right? This is kind of the bottom of the 8th inning, and we're kind of battering up now for the end of the game. So maybe starting with the equity side, and then maybe to touch upon what Willy said about the rotation. Like, do we have to look beyond just Bitcoin at this point?
So in terms of equities, yes, there's another leg up there. That's quite clear. I think there's, again, when you work with Fibonacci levels, it's really what gives us the idea of how high this can go. And I've said a long time that above 7,500, potentially 7,800, I think you're probably going to touch in 7,800 on the S&P. So we're not there. NASDAQ, 29,000 is possible, 28, 29,000 we're not there. These are the Fibonacci levels. And I just want to say right now here to everybody also, as you can see something like Filecoin or Philcoin or whatever, how you pronounce it, is up more than 100% today. That is not something we would see if we were in a situation where Bitcoin had topped out 3 months ago and we were now to expect it to head lower. So I just can't make the things add up here. And when it comes to the to what we see into a final phase, I'm 100% with you, Willy, on terms of this with the divergences on things. I don't see that on liquidity, but I see it on the RSI. Maybe I can show that. Yeah, let me just share.
Yeah, let's try to be as specific as we can, right? So always data back where we can.
Yeah, this is by the way what we have here with Phil that is up right now, and keep pushing. But if you look here at Bitcoin, I mean, yes, we have divergence, but divergence can sometimes last for longer. And I don't know how that is with liquidity, and you know that better than I do, Willy, absolutely. But I see it as there needs to be 3 touches, and it's also where the structure of what we have here is playing in. And to me, we are actually standing just in front of a very, very large move here. And I say a 60% move, which I could see. Don't call me crazy, but even in November, I could also see it into early December, but I don't think we need to go much further than that. Because if you look to Bitcoin, we have it here. And we look, for instance, at this candle we had over here. This was an 88% candle from bottom to top, 88% in 1 month. So when we're now up here, people cannot tell me we cannot have this here. I say we can have that easily into December at least. And I could even see it happening here in November, because I think we're about to see something we just haven't seen, which is the real blow-off top. So I still think we're going to go up here. And I see that now also with the beginning of the cryptos. You can see now if you look at others here, they are already pushing. This month they are already up now and are pushing really hard, and they are more than 10% now for the smallest coins we have. We definitely have a rotation, and that rotation is only coming if we also still have some Bitcoin strength. And then to the timing of it, we don't need so much time. People think, oh, this is going to last a long time, because we can't envision or imagine a 60% move. We've seen it many times actually. So this that we don't need much time is something we can just go back in the Bitcoin dominance chart and look at. This was a 5-week period where we covered this ground. This was a little longer than that, maybe 8 or 10 weeks or something like that. So when I'm saying we could be down here by the end of December or beginning of January, I don't think that's a big problem. So we are now, if we look closer to that, we are beginning to see that drop now out of this wedge, where this was the annoying second wave, the beginning of the alt season actually here, the bounce in it, and then we're coming down, and now we start to see this move, and we start to see the altcoins actually starting to move. So I think we have this rotation going on. That was the first question. What was the other one, Yann?
Bitcoin being specifically, so do we have to look at this in a broader sense, right? Because as you said before, Bitcoin obviously needs to have strength. If Bitcoin really starts shitting the bed, which it has been doing over October, it's not going to give us that bedrock, let's say, or that foundation that we need, right?
And I can completely follow that when we look at something like this and we say, well, this doesn't look too good, but that's actually exactly how it needs to look. That when we have the final blowout top, and if you studied enough charts, you will see that the final push here, momentum-wise, into a structure like this is where price goes insane, and momentum is not really behind it. That means that people are taking on more risk, and I don't know how to express that in liquidity there, Willy, but that is the moment. That's what we see, and that is actually why it's a massive top we're looking at, and people need to be really careful when we get up here. So yes, enjoy the blow off top, enjoy what's coming here, but be very, very careful, because this can turn, and I think you will see that it moves right into a level, and I have above 160,000, and then you're going to see it come down very, very fast again. Everybody will be all bulled up, but I think it'll come down to lower levels very quick, and then you may see a bounce into January or something like that before we head lower. So in the biggest scheme of things, This is a very, very, very negative, bearish picture for Bitcoin. I cannot express this enough. My own way of doing this, and this is something I have developed in terms of looking at charts technically, the place where a divergence begins, which is here, the move that comes where it comes from is the minimum target you will be reaching in when this whole pattern unfolds. So if I'm right that we get this bounce and we go down here, then we're talking about this as a minimum. That's 20,000, and actually more likely this as a minimum. So that's a crash. That's a 90% crash. And when there was somebody asking me, but why am I so negative on, in the long term, and why dare it? Well, because there's too many things still showing us that we are not at the top here. I mean, Ethereum has only in doing a correctional pattern here. This is a very clear correctional pattern on top of a line that goes here. So what it shows us is that it came up, it corrected here, and it gains new strength. People become all this, and fall into despair, and then it just moves the other direction. And when we get up here, everybody will be pulled up again. So I think we're at that point, like we were in April. And for those who are our clients, where I said I think we're going to get a V-shaped recovery in the in equities, and that's what we have had. I think we're going to see the same in Bitcoin, in altcoins, and in Ethereum here. We're going to see a very, very sharp rally, but on no momentum. A lot of risk taking, a lot of people, pouring in, and a lot of talk, and a lot of speaking of how fantastic Bitcoin is when we get up here, only to see it putting in a big top.
Basically, irrational exuberance, right? It's going to be irrational, not foundation, like fundamentally driven, which is always
No.
Yeah. When you're talking about momentum, just to be clear, because I'm using different terms, momentum, you mean no fundamentals behind the move. There's obviously momentum because the price is running upwards. Is that what
really? It's basically the way that I would define it, right? So if momentum is the force in the like how strong of a force the move has, the fundamentals or the liquidity is the potential energy. So how much further can that momentum go for?
Yes.
And I think what's super interesting here from a kind of an objective kind of bystander, right? As you guys discussed this, is that it really is that combination, right? Where you have the momentum, but you don't have the energy to really propagate that forward for a prolonged period of time in the way that we've seen it over the last year and a half, 2 years, right? And I think this is the key question. And I think where one ends and the other begins is where you can kind of describe the irrational exuberance, right? Kind of that irrationality, euphoria that comes out of nowhere because capital is kind of looking for that next opportunity cost, right? Of kind of, diversification, whatever it ends up being, triggered by a catalyst, which I think very well could be the government shutdown resolution, right? Because markets at the end of the day, yes, on a longer time scale, they get influenced by interest rates and all these other kind of dynamic factors, right? But more than anything, it's about certainty. So markets thrive under certainty. When things are more predictable, you can go back to your fundamental analysis, cash flow analysis, discounted cash flows, all of these types of things on equities, where you can get an understanding of where things are going. Where markets don't do well is with these kind of random shocks that come out of nowhere that are very difficult to price in, right? And I think this is where I can definitely see that kind of that Goldilocks zone type of situation where the Fed is easing into a kind of euphoric, kind of risk-taking type of environment as people look for the next big opportunity. And from my experience, there's one thing that changes sentiment quicker than anything else, and that's rising prices. It really is that simple, right? And that feeling of having sold the bottom, seeing everything move 100% against you, and then kind of triggering that euphoria or kind of that FOMO, right? Of having to get into position. And I always remind people as well, it took $5 billion of inflow into Ethereum to move it from 1,800 to 4,000, right? 5 billion of new capital. Of course, there's also the increased velocity of money, right? As basically existing capital starts chasing, the reduced float, right, that exists. But it doesn't take $500 billion to move Ethereum or to double Ethereum from here in terms of actual capital, right? Exactly. So maybe to open that question to you as well, Willy. So in terms of the fundamentals, right? You have maybe if you can open up that chart that you showed on Twitter, which I found super interesting. I mean, obviously,
Let
you shared it
me,
with me beforehand,
yeah,
but I think that was
let me
very
do
interesting.
that. Also, I want to paint the picture also of, we talked about the altcoin flows. We normally see altcoins really rally, and this has been a really disappointing year for altcoins. And people have talked about the Bitcoin Treasury companies starting to come in and take the lead, and why trade alts when you can, get the MNAV expansion on these treasury companies on Bitcoin. But of course, we're also seeing what invalidates that is that we're also seeing debt, digital assets, treasury companies rise, and that hasn't turned things around. Um, I would say it did create, Tom Lee's one did produce a bearish flow in Bitcoin because they accepted Bitcoin, and it did pump Ethereum actually, and that created a mini alt season. But that was a large one. There's one thing that people don't usually know about, and this thing happened after FTX when they had huge bags of Solana. And in the receivership process, they sold big billion-dollar bags of locked up Solana to asset managers and hedge funds at large discounts. Okay. And so if you take that on board, you have to respect the terms of those lockups. So they were all legally bound not to sell the asset. Um, but that didn't mean they couldn't hedge it. Now we're in post 2020 now with developed perpetual swap markets, and it means that you can sell the asset even though you've got the bag of Solana in cold storage. You just hedge it out, you short the market, and effectively that sell pressure goes into the market immediately, even though these tokens were promised to be not dumped on retail. Now, from that learning, every single significant treasury that has the ability to unload their altcoins under these lockup terms have gone out to hedge funds and and um and sold their tokens sometimes at 30% discount, sometimes it's a variable thing based on the discount that you're going to get. And these hedge funds are now like, I will hedge this. I'll collect a basis trade on the short, and I will also get that discount. And if I run that analysis through, I'm making 30 or 50% annualized return, which is great if you're getting a yield, a good market neutral yield with very much good risk protection. So what that means is all these altcoins have a lot of sell power in the cycle, right? And so in the past, altcoins were moved by number one, retail, but more than that, it was moved by whale traders that could buy a pile of these coins, and knowing that retail would come in, get the momentum, you get out, right? Alt seasons. It's kind of a little bit like a pump and dump. That's what an alt season is. You and what's happened this time is if you're any kind of sophisticated player, you're going to go, I'm not going to do this game because the sell power's already there. And like the through the hedging, all of those treasury companies can dump on you, and they already have. The sell power is out now. And then you've seen retail not even come in because they're wary of VC coins, and they've gone to meme coins. So I think there's a huge impact on altcoins. And my argument across this analysis is this time is very, very different structurally from ecosystem, you know, considerations like that. Altcoins always followed this behavior XYZ in the past. Well, it's different this time, right? What was different was we had futures instruments, and now we have lockup terms passed through. What's different about this time is also retail is largely absent relative to the size of Bitcoin. Like last cycle, we were making moves from 10,000. Now we're making moves another five times more. Um, it's now up to the institutions to come in to move the needle. If we're talking about fundamentals, um, that's a lot of money. Like retail coming in is not coming in at the rate it has been in prior cycles. the amount of money that's moving the needle is much smaller. So you're not getting the FOMO dynamics in the price. You're seeing very measured deployment by institutions. And so it's created a very, very tame kind of environment. So although we're talking, 60% moves in 1 month candles, if you look at that into what year was it? We cannot superimpose a 2017 or a 2020 cycle. This is a 2023 to 25 cycle, and the capital dynamics are different. Bitcoin's growing up. You can call it the IPO moment, but there's all these nuanced individual things that are happening inside the ecosystem that when you look at these candles and you look at the chart, they're kind of different charts. This is an animal that was born, it's nascent, and it's growing up into a bigger mature animal, but it's not there yet. And so you can't really just say you can't get the 5-year-old clothes and say, look, this is this feature about those clothes, and then put it on the 13-year-old. It just doesn't fit anymore. And so that's my I think there's danger in analyzing Bitcoin using past y-axis behavior. I think x-axis behavior is more reliable, the time signature, because there are trends, and trends do exhaust, and these generally that doesn't change, and so yeah, that's where I'm basing my analysis on, or my view, let's say. It's just Bitcoin's a different beast this cycle, and it can completely move in a different direction from you know the big indices. So I'll just share the liquidity chart I posted. I'll just zoom into where, see, this is here the leading signal, right? And it is, you see these are divergence in this local area where it's still coming down, but the leading signal's going in a different direction, which should be a stabilizing force if this continues to sort of bounce back higher. And that was the same here, right? Was now you see this leading signals climbing, and liquidity hadn't turned around, and then it follows. And so, like, look at the time it takes for this to fire that divergence, and liquidity coming back in, early signs of it, liquidity actually turning around, and then the time at which the price starts to move and respect the buying power that's coming in. Again, it turned around in this zone here, the divergence happened. How many weeks it took? It took around 2 to 3 weeks for price to respond. So this is when I'm talking about the time we've got left. So let's talk about late November as price to move. Yeah.
Just to ask, sorry, Willy, because I think this is a really critical point. A lot of questions have come up to kind of for us to clarify what we mean by liquidity. When you say liquidity here, is that new capital coming into the system?
Yeah, so what we're trying to measure here is when we talk about liquidity, Raoul Powell will maybe talk about liquidity as like the amount of money in the system, how does that flow through the ecosystem and buy risk assets. What I'm measuring here is some of that flow coming in to buy a risk asset called Bitcoin. So we're trying to measure the capital coming into, I used to say the capital coming into the network because I was measuring it on chain, therefore the network's holding it. But actually, it's much more sophisticated because it's an asset and you can't measure everything on chain. So we're now taking exchange data to make an estimate of the quantity of capital coming into these markets, and not coming off chain, which would, that's a base of measurement. But let's take exchange data. I won't say how it's done, but it's a quantitative view of how much capital is coming in across the exchanges. Because I could buy a Bitcoin, 100,000, I'll buy a Bitcoin. Great. I don't put it into cold storage, so I'll never, it's blind, right? It's so you need the exchange data to make an assessment. So this is all estimates. Of course, we can't get into every single exchange and get every single buy sell across the ecosystem. Some of it's, indexes, some of it's in invisible OTC flows. So But we'll make an assessment here. It's just basically flows of capital. And you can be slightly out if you're just measuring the flows going into cold storage, self-custody, because you're missing another aspect of it. So that's it. It's just flows coming in. And so already, we're seeing an opportunity for a bottom. This is like a developing bottom signature. This isn't falling off. If this keeps rejecting and coming lower and lower, and this starts going deep in the red, then that's a confirmed bear market. But the fact is, it's starting to turn around. If it completes that, then we're into late November for price to start to turn around. And the question is, how can we get through all these resistances and move to that kind of end of cycle rally up to the 150 in the intervening, let's say, 30 to 40 days. If, timing wise, it's going to be fourth quarter. I can be completely wrong, by the way. If like, I know that Yann thinks we're going to go into January and then there's more time, right? But I want to show
I don't know either.
this.
There's a chance, right? So we deal in probabilities here.
It's
I do want to.
probabilities.
I am going to add a point to what you just said before. That's why I wanted to make that distinction, because there are two different things that matter in a, let's say, complex system that is kind of driven by liquidity in the way Bitcoin is. And that's the inflowing capital. But there's the other side of that coin, which is the velocity of money. So the capital that is in the system already, that is being slushed around, can go from, let's say, one asset to the other. But that also creates a similar type of, let's say, dynamic or flywheel on the appreciation or the underlying price of the asset, but is less persistent. Because new money flowing in is basically making the pie bigger. The money in the system is the same size of pie, but can reshape, let's say, the size of the pieces that you're carving up, right? And what's interesting this time around is that you're correct on the new money flowing in. And I think what's interesting as well on the peaks that you see here, the two most recent high peaks, is that they were completely driven by a convergence of a narrative that was so obvious, so clear, that it was unavoidable by larger asset managers, right? Where that aha moment, that Pandora's box moment of, okay, now you need to allocate, right? The ETF early 24, Trump's election, and the expectation of higher or less scrutiny and higher level of attention towards the building and the regulatory framework that would kind of come out of that. And the question is, do we get another one of those types of environments or situations, right? Where, let's say, the government shutdown coming to an end, and then a wave of liquidity going the other direction, right? It could be led by equities, whatever it ends up being, but it kind of sets that situation again of a risk on type of environment, right? Where kind of markets go back into that state of, okay, things are more predictable now. We've had a big bear market earlier in the year, right? We've had a 25%, 30% drawdown on major indices, right? I'm talking TradFi here specifically, that being kind of the underlying premise. And on that point as well, so going back to the liquidity point, what we are seeing definitely with the BFI, right, with the tracking of the velocity of money, as we are actually seeing a increase or a fast uptick over the last week and a half of existing capital that is now generating faster. So the velocity is picking up. And at the end, in terms of the short term, so we're talking the next 2 to 4 weeks, you can look at it as a kind of a primer, right, that is needed for the catalyst to then actually come ablaze and actually kick off a inversion of that flow again, right? A sort of a reason for that to start happening again, and that could be driven by higher prices, right? It doesn't take much from that perspective, and if that kind of aligns with a clear, non-deniable event like a government shutdown resolving, that can set the stage for what Henrik is talking about. And that's definitely not persistent, because we know that the fundamental flows are not really backing up a persistent momentum, like you said, the persistent force that just kind of goes on and on and on, like it did in, let's say, early February, late January of 24, and obviously November into early December of 24 as well. And I think that's really the question mark, right?
We're picking that up here in the liquidity model as well. And I mean, it is relatively a short time frame. It's very hard to project what will happen other than the next, like, 3 to 4 weeks. But what I've done here is also zoomed out on the liquidity picture over the broader, 5 years. And you'll see that again, there's a weakness in this liquidity picture not peaking enough in this to make this area very valid. And so we've created a kind of a strong bearish divergence in liquidity, and you can see that, you can see this is a bearish divergence where this was completely not validated and nearly got to the same, like a double top formation almost, but there was no liquidity, and wow, we came all the way back down here. Um, and so the same thing here, like the same pattern happened. There's another top, not enough liquidity, had to purge down to here. 2020, 2021 bull market, this also showed us that it was a bearish divergent. We had to come back to half the price again. In fact, these liquidity flows were actually akin to a full bear market, like significantly negative. And then we had a final kind of dead cat, which created a double top. And that in itself, again, showed a bearish divergence that was unvalidated. And then you'll see like the opposite happens, right? You have the divergence on the bullish side where this sell down here was not validated by significant liquidity flows pushing it down. So that was the cycle bottom. We got the divergence again. So lower price and liquidity picture stronger than the prior. And so when we're talking, these are very broad timescales. We're not talking next 4 weeks. We're talking about inside the macro cycle. So I could totally see this recovery. But what we're talking about is the liquidity picture saying to rise and rise and rise and rise and rise and rise and rise up to something like here, right? Already you can see where my cursor is. That's into 2026. We need 2026. Judging from how long it takes to recover that liquidity. People's behaviors have a timing signature, okay? It's not instant. So this is again, like liquidity pictures telling me a timing signature. If I'm completely wrong, it goes into January, February, we're good. If we end like every single bull market top in the past ended in December, then we're in trouble. And there's reasons why December, right? Because we used to talk about the end of year tax sell-off. You sell a bit of your asset because you've got to pay the taxes on the gains. Maybe that's not valid this year. Maybe where people aren't trading alts, people aren't trading treasury companies. They don't have incurred a large tax bill. So I don't know. But if I look at the technical picture and zoom out to monthly and quarterly candles, it's near trend exhaustion also for fourth quarter 2025. And so going with a technical analysis of a trend reversal, trend exhaustion, that's this quarter. And it's actually an interesting one because it's a stronger reversal. It's akin to the dot-com bust and the dot-com bust, the 1971, when the fabric of money got completely reset, and also the Great Depression. Those were the trend reversals over broad time spans that we're looking at. So even on the technical level, it's kind of agreeing with Henrik's view that this is like an everything bubble. So
Go further to even gold, right? I mean, the fact that it went exponential,
yes.
like a $30 trillion asset going, I guess it's mind-boggling in a lot of ways.
Yes. And when that fires, that's like it's chaos. That's chaos. There's something completely toxic in the system. And when gold rises like that, those are also the times where gold rose. And we had a decade long of sideways chop in equities for everything to sort of detoxify. So yeah, it's an interesting one. It's a very interesting cycle top. This one, it's very global macro driven, I think. But
So
locally,
I think another,
yeah,
it's like another point as well for our audience, right? Like a lot of October due to many structural reasons as well. We've seen a lot of the brokers deal with toxic flow, right? Because of the fact that there was an insider knowledge of dumping and selling, or more extensive selling due to these kind of cartels or kind of whale syndicates. And that's generally also not great for the plumbing, right? Because you kind of have this situation, for those of you that don't know what toxic flow is, it's basically a situation where the trading activity that underlines the price, let's say discovery, is unprofitable, right, for the broker, where he's kind of constantly taking losses, or let's say market makers in this case as well, which, as much as we sometimes hate market makers, they are in a necessity to be able to generate liquidity, right, and to be able to actually efficiently find price discovery, let's say. And it's basically been kind of this environment dominated by traders that were exploiting these inefficiencies with information ahead of time, right? I can't prove this for a fact, but there are some larger accounts that have been majorly short over the month of October, September, that seemed like, if you look back at some of the events that happened, they had prior knowledge. They had knowledge from these larger sellers that basically that they were going to dump into the system. I think that's why they were so certain to go short with like a 2, 3, 4, 5x levered position. You would not do that if you didn't have asymmetric information, right? So we have had a little bit of that, which obviously doesn't help, and takes advantage of a situation that otherwise would actually be fairly healthy, right? But yes, to that point as well, just to quickly share before we jump into the actual questions as well, let me quickly open one chart that I wanted to share as well, to kind of, that adds to what Willy was explaining before. You have a situation here basically where you look at the aggregated flow, right? So we're as an entity, or like as an organization, we're not only interested in the number of money or the amount of money that is coming into the system in a unitary basis, so number of dollars inflow, but we're also interested in understanding how efficiently the capital that is on the sidelines and is in the system is being allocated. Okay. And what's interesting this time around is that we have had a stronger impulse basically after the October 10th crash, with passive allocators coming in and slowly buying, kind of getting their toes wet again after kind of that massive volatility event that we experienced. But a lot of that has been driven by internal, basically allocators, right? So we track this with the velocity of money. So usually when the velocity of money goes up, with flows going down, that is recycled capital. So capital that has been basically trading Bitcoin all of a sudden flows into Ethereum and then flows back, right? So you have this kind of this circular motion that doesn't really generate any real sustainable price growth, but does create short-term kind of volatility spikes. The way that we would measure that as a fund is we would identify that as a environment with high volatility. So volatility skewing to the upside, but not really in a sustained fashion, because you don't really have momentum, right? So the trend, the auto correlation in the returns is not really there, right? Because by the time you get into position, you're basically getting stumped out. We're starting to see a change in that. So it's not confirmed yet, but we're starting to see interesting developments that might actually indicate that we are maybe more similar to the beginning of a November type of situation, which would confirm or kind of give an additional credence to what Henrik was saying about a potential blow off top, where you have an alignment in the system of exchanges, market makers, large allocators, also TradFi related flows, all converging in one synchronous kind of event where everybody benefits, right, from a actual blow off top or a fast move in the price, so that you can create exit liquidity, right? I would never ignore that, and I actually think that a big part of the end of 2021 was an actual similar type of situation. We had insiders that were trying to generate exit liquidity to be able to actually get out of position. So that is basically what we're seeing right now. If that does happen, very volatile. Now, does that end in December, January? It's impossible to say. I think I can find arguments for both sides. But what definitely is interesting is that primer, that thing that dislodges a potential uptick in liquidity as well, is potentially there with that increase in velocity of money. And you can see that right here at the end. Exactly. So maybe spending a little bit more time on the actual questions. We want to maybe go through the the questions that were asked. Oh, there's actually quite a lot.
I mean, this is kind of asking for advice, but
Yeah.
I'll read it. I hope I have enough money to join the altcoin vector after the bull run. Would it make sense to join during the bear market, or shall I wait for the market to recover?
Most sense right now is to try to find clarity, to have a very easy to follow, easy to adjust strategy, and try to avoid all the noise, right? So avoid Twitter, because I think with Twitter, every time you scroll, you get 20 different things that kind of negate or kind of go against what you read 10 seconds before, and try to come up with something that makes sense to you, right? So important here being never over leverage, never overexpose, always have reserve capital, like some cash in the sidelines, maybe 20, 30% that you can add to a position, and follow something that makes sense. So I think what would make a lot of sense here, definitely, I think, is Willy's analysis on the Bitcoin Vector Lite. I think it's world-class in terms of simplifying down all of these hundreds of different concepts into a view of liquidity, which is massively important to understand how far that momentum can go, right? That Henrik was mentioning, like how far can it blow off to actually, like what timeline can that actually happen in? And on the other side, also have an understanding of the momentum. I think that's where the Bitcoin vector and the altcoin vector are very important, because that's where we, as a fund, together with Willy and Henrik, analyze momentum, right? So those are the two most important things. Is momentum existing? And if yes, does liquidity support a prolonged environment where momentum just keeps going up, like we had in November and February of last year? So short answer is, I would say yes. Already start as soon as you can.
Okay. Jacob writes, typically most other alts top out after Bitcoin and Ethereum. If Bitcoin tops out this year, Ethereum, he said ETC, but I'm assuming it's Ethereum instead of Ethereum Classic. I'm guessing the remaining alts top out between January and March 2026. That's the $1 million question. When do we top out?
Well, I will put a few words on that, because if you go back to the previous tops, you'll see that it's not that kind of difference we talk about when it comes to the top in Bitcoin and top in Ethereum and altcoins. We talk about 3 weeks or 4 weeks. That's what we saw in 21. That's what we saw in 2017. So if you have, and I would like to try to see what I want to emphasize. It's not important to me to put out the date here or the timeline. For me, it's about the levels. That's what I need to be better to also communicate on X. I think for me, it's about the levels, because when we reach the levels and we see a combined across the board kind of thing starting to happen, that's the moment we need to start moving out of positions. So for me, I will be long for as long as we don't see that. But if I had to put some kind of timeline I think you're going to see a move that is faster than anybody actually understands here, because we need to have sentiment all at the opposite spectrum, at the other side of the spectrum now. So I think you're going to see it into December. And why am I talking about December and holding on to that? I do that because of what I see in the dollar. And the Dixie, as you might have seen, it just bounced from around 95-ish, 96-ish, up to 100. And I actually think that was some of the headwind we had for equity, for crypto especially. And I think it's now put in the top, and I think we're going to see now another decline. But that cannot go on forever and ever. And there is a massive building divergence on that one, which gives us, when we come to late December, then I think it's about to be careful. Will crypto top immediately at the point where Dixie bottoms out? No, probably not. We could see it, moving up a couple of percent or something like that. But if it starts to cross 100, I think that's the moment where the shit hits the fan. That means that if we get the Dixie, when we see the bottom in the Dixie around 96, just below, then you should start to be careful, because then I think the Dixie move higher will become headwind. And that's why I think I would not be looking in for a timeline here. Observe what you see in the Dixie. The Dixie is the king dollar. I mean, I forget about Bitcoin and crypto and so on. The king dollar. This is where, if you go down to your bank right now, you tell them, what, this car loan I have or whatever, I've got all these Bitcoins, you'll say, fine, come back when you got real money for us. The same will do everywhere else. So by the end of the day, when the shit hits the fan and we're going to see this top, pop, you're going to see that real money is needed. And real money, where the most debt is denominated in, is US dollars. So observe the dollar. I think there's another decline in it, but when it bottoms out there, then the clock is starting to tick. Until then, I think we're good. So, but can that be in January also? Yeah, sure. I could see it also going into January. That means, and then just watch out for the Bitcoin topping out potentially first, and then watch out 3-4 weeks later, maybe as if we follow history, before we potentially see a top in altcoins and Bitcoin. That's at least how I try to think of it in terms of timing.
A lot of it has to do with private markets. So what we're looking at very carefully and much more specifically is private credit, private markets, and how things are moving there. Because I think it seems like the ticking time bomb here is going to be on that side of the equation, especially considering the size of the shadow banking system in the US, right? So shadow banking being entities that give out loans and credit that are not necessarily banks, right? They're not regulated in the same way that a financial institution would be regulated. And I think that's a $1 trillion problem as well that is, that is kind of starting to potentially derail, right? So there's some signs that are not very positive. That's potentially also aligned with that December.
Yeah, and sign of that would be a stronger dollar, because you now have to
exactly.
Yeah. So that's
widening SOFR and Fed funds like overnight rate, and then like you would see it in different areas. Like you would see kind of the gas pipe exploding, like the what's it called, the bolts flying off, right? So SOFR would be one of them, dollar would be another. Yeah.
We don't really see that kind of stress just yet, but I think actually there's a complacency between the real world where we can watch into what we see in the banks, and then this shadow banking world now, where all sorts of businesses have become kind of a bank, and we don't know what their balance sheets are simply containing. So I think that is the problem this time. This will be a domino setup, where the last time we could look at 20 large dominoes and we could kind of fill them up with money, and then they could, if they didn't wobble or didn't fall, then we could save the world. This time it can be much more opaque. It can be domino set up in the dark where you don't know where to stop it, and the outcome of that will be a very, very strong dollar, because that's where all the that's how you need to settle debt in the world. And that's why I think the strong dollar is what you need to understand is the theme into 26. And just imagine if I get it right, 120, 123 on the Dixie. Don't forget about crypto at that point. Forget about the Bitcoin, at least for that point, until that moment. Then it's about staying liquid in real money. And then it's about understanding that there will be opportunities coming, but you need to be not in the highest risk asset that you have at that point.
Maybe that want to dig deeper into the shadow banking part. It's things like Klarna, for instance, for those of you that maybe have heard of it. It's the kind of buy now, pay later types of systems that are very prone to seeing higher default rates once people start feeling the pressure of the next paycheck, right? So it's things like this, and that's basically what we're looking into. I think in terms of your point, dollar or Dixie at 123 kind of leads to the next question. Will Bitcoin drop 80% in the bear market? I mean, if you have a credit crisis, so it's not just there's two types of crises, right? There's the solvency crisis and there's a liquidity crisis. In a liquidity crisis, you might see short-term bad situations for Bitcoin, but it might recover faster, because then it's maybe just an injection question. A solvency crisis would be where you have bankruptcies across the board, because the asset side of the equation is also not worth anything anymore, right? Where companies are not able to actually raise capital in a tight credit market. And I think in the latter, Bitcoin could potentially even fall to the 14,000 that Henrik is saying. I don't see it as extreme, but I can definitely see the 80-90% drops if credit becomes super scarce.
Yeah, you can just look at what. It's Willy gone. Sorry.
No, well, I wasn't really going to say anything other than Bitcoin has never ever experienced a business cycle downturn, because it was built in the wake of 2008. So we don't know how it behaves. So all our models will be broken, I would imagine. Like I have a bottom model that's probably saying around high 30s, low 40s. I don't necessarily think that will hold. It might, it was built and it predicted the last low of 16,000. But I think, I think that we were too reliant on models within our ecosystem, because we're very much looking like every cycle can be blueprinted, but there's only 3 prior cycles. That's not enough data points to go on. So we've got top models, though they're not firing either. But actually, if I look at the metrics, they're kind of broken as well because of the structural changes in the market. You're measuring the wrong thing, or the wrong thing is drifting, or the right thing is drifting. So, yeah, Henrik.
No, I just want to say that look at the housing market in the US. We don't what the thing is when you have a business cycle rollover, there are bad ones and there are good ones. The good ones is like in 2001. That was the pop of a bubble, and not much happened around that time. So we didn't see a very strong decline in GDP. It was not a bad one. The bad ones occur when you have a housing crisis, like we had in 2007 to 2009. Why? Because it becomes a balance sheet recession. It's when actually it's not just you losing your job. You're losing your job, but you cannot afford sitting in your home, so you need to sell it. But your home is actually underwater, and there's nobody wants to buy it. Then it becomes a banking problem. These are different kinds of recession, and you have to look to back in history, understand which one of the balance sheet recessions. The one we're heading into right now is similar to what we saw in 2008, but also with a top like in .com days in 2001. So you have both now. It's fantastic. They have created. That's why I call it the everything bubble. You had a 2001 now valuation, which we now have surpassed. We have a bubble in the housing market. People say, yeah, but we don't have the speculation. No, but guess what? Prices are up so much that people can't afford it. So right now, the number of existing homes sold is so low, and everything is at a standstill. And maybe you guys from the US here can support me on that. It's really, really standing still. Now, just think what happens if people now lose their jobs. They have to sell their homes that they cannot sell. I can tell you it's going to be a balance sheet problem. And who's going to get that? On the banks. What will the banks do? They will have to call back loans. So the trigger of this is already there. It's in the cards. You have it. The balance sheet recession is going to make this a liquidity crisis, which will unfold at some point. And the Fed will try to react. But there's one thing the Fed cannot do, even though they think, is they cannot force the hand of Mrs. Johnson. Which means, why do I say that? Because it's down to psychology. If Mrs. Johnson sees that she loses her job and her house is coming in foreclosure or something, she will not run out and spend the $100 she saves on her mortgage or a car loan now, or whatever, on something, buying something new, a new sofa or a new whatever. She will keep it back. She'll hold on to it. And this is the whole thing. That is the whole psychology that the Fed is just taking for granted. And they think, hey, they're going to react the same way. Guess what? Psychology is a very human thing that we will change. And when we see that inflation has been going up, I've lost my job and I can see my home is depreciating, not so prone to go and spend the money. And if you don't, then you will not see the effect of QE. You will only see potentially it's starting to circulate in the banking system with all the crazy bankers, and you're going to see that it will create a commodity kind of boom instead, and you'll see stagflation. So you just want to be careful here, because I think that it's already in the cards. You can look at the housing market in the US at a standstill at a time where people haven't lost their job yet. That's the problem.
Just with the recent time, maybe to go ahead, Willy.
With the recent layoff numbers, institutions are leaning towards a rate cut in December, which should weigh down TradFi to year end. If consensus is there's no rate cut, will that reduce this potential last upward impulse on Bitcoin?
Is probably going to be a bigger factor, just because of how it affects spending, the net marginal kind of expenditure in the economy, and also the TGA. So the general account on the Treasury, which is probably going to start basically getting drained, and it's going to get pushed into the system. I think we need to have probably a separate discussion just about this topic, because it's quite complex. Just understanding how the repo system actually works. But I mean, rate cuts are obviously, I'm assuming they're not off the table, right? Even if you look at the implied probabilities, it's still more likely than not. Henrik, I heard from you today that they were going to do a emergency meeting around this. Is this been confirmed?
I haven't been following up on that.
Okay.
I haven't seen anything on that. So I was at the gym before getting here with you guys. I need to also work more on my brain. So I haven't followed up on it, but I think that they might. I mean, they could start to see. We've seen all the repo actions that's been going on, and there could be something going on underneath the hood, as we don't know about that. they definitely have seen the job cuts announcement. And again, that is something that was probably not what you want to see if you are a bit hawkish, as the Fed was, as they said the last time. That was, kind of ridiculous. So standing there saying, "Oh, we are a bit, on the hawkish side," which more or less what he said. So I think
aware that they have a bubble, right? I mean, I think they're very well aware that equities are hot.
I think that's the problem. They talk about that they have a dual mandate and that it's inflation that they're afraid of. They're not afraid of inflation. I don't think that's the truth. They can look at housing, they can look at all the things that will drive inflation, and also the fact, if you look back in 2008, inflation was much higher, and they were cutting like crazy, and they did not know we had a recession at that point. So inflation was above 5% at some point in 2007 and 2008, and they were cutting. So inflation at 2.7, forget about it, it's nothing. What the Fed is afraid of right now is, as you say, Yann, they see that there is a bubble. They don't want to say there is a bubble because they don't want to pop it, but there is a bubble, and they don't want to ignite it or fuel it. Problem is, it's already there. It's out of their hands, and that's the problem right now. So they can now watch it grow bigger. They don't want to fuel it, and at some point, it's going to pop. So that's it.
Can't liquidity into Bitcoin change quickly? Imagine the Clarity Act passes. The US government says it is acquiring Bitcoin. Also, can't price go up quickly without new liquidity? There are 30 billion in leverage shorts around this price that could be liquidated and create an event opposite of 10th of October. Sure, anything can happen. We're talking about a liquidity claim. If I'm looking at the climate liquidity, it has to be something akin to like the tail end of 2020, 2021, where we had a mass run. Like nothing stopped Bitcoin because so much money was coming in. It rolled over technical indicators, rolled over shorts, rolled over everything. And so that could happen. It's just haven't seen that in 5 years. If anything, the slopes are flattening out. Can price run out without liquidity? Yeah, for a short amount of time, but not going from where we are right now to 150,000. There would have to be a massive liquidation, and those short positions aren't in there right now. So you'll still see liquidity come in. When price is running up, just the way in which the maths works, liquidity comes in.
Demand. So that's akin to liquidity. So there needs to be actual underlying spot demand for anything to happen in a persistent way. That's basically the bottom line. Yeah. So I think you're fully right on. Next question. Could the market's peak be delayed until Q1, Q2 instead of this Q4 as the impact of new Fed chair begins to be priced in, especially midterm elections, builds potential political fiscal maneuvers? Push back the final blow off top. It absolutely can. Like Henrik said, it's for him more the levels. For us, it's really about momentum, right? So if we have evidence of strong momentum and strong liquidity, there is a case we made that you have strong price direction, volatility, which is force, and the underlying potential to kind of keep that moving in the same direction. So that can absolutely happen. As we said before, what happens when there's consensus, government shutdown is out of the way, all the major problems of this year are out of the way, all the themes remain with AI, capital allocations, a lot of funds still underweight the indices that they got out of in March, April, right? So you have that continuation into the end of the year to make sure that, or kind of that incentive to close the year in a better way persists. I can definitely see it move into next year. It's possible. But to Henrik's and Willy's point, we're definitely running out of time, I think. And that, by the way, doesn't mean that you don't get another bounce in January. It's just not an all-time high.
Exactly. Watch the dollar. And I think for now, I would say expect a bad January. For now, I'm not saying it will be, and it's not destroying my thesis. As Yann says, it can move a little further, but watch the dollar into end of December and watch what we're going to see in January. Because if we get a strong sell-off there, which I could suspect, then I think it's it. Then I think we're heading lower. But doesn't mean, remember, back in 2007 also, we saw that the top was in October, and we then saw back only the market actually bounced back up again after Bear Stearns, which we all remember was in March of 2008. And then we had the big sell-off only after that and into September and so on, after the summer there. We could easily see something like that. When we say the top, it's not like the next day will be Armageddon. it can be that you have a decline and you'll see that this is the top, and then it takes a while before we see the really big sell-off, and we have some bounces on the way. And I do think that will happen to a certain degree. But watch January. I think that will be a tell sign, and watch the dollar and watch the VIX also. The VIX is around 11, 12, and I will say then you should be careful because I think it can spike really quick there.
So there's another question around, do we see it at 200 to 250K? I mean, given also the point that Willy made, just given the time, the amount of energy that you would need to push at that, it's probably unlikely, right? I even see the 168 that you mentioned as quite a stretch. I'm more in the 130 to 150 camp if we do see an all-time high. But
what?
Yeah. I know that we have divergent.
Hey guys, now we have, I don't know how many we have on here, but I'll bet you two guys something, a nice dinner somewhere. We'll see above 140. Then you'll go along with it, right? And I got an easy.
We'll do wagyu with beluga.
And I got an easy dinner then.
Sounds good. So actually, what risks arise from the high concentration of Bitcoin holdings among whales? What you just saw in October. That's, if anything, a prelude to what could come. But yeah, once those guys start unwinding, it can be very detrimental, to Willy's point. So
I
again,
would make one caveat. Yeah. One caveat on that is that everyone's talking about that, but the metrics, on-chain metrics, are very broad. When a whale sells, generally we're not tracking coins, that wallet going to an exchange or an OTC provider. Generally, we're tracking those coins moving out of a wallet. That's it. And that can be like Adam Back, for example, launching BSTR, where there's 25,000 Bitcoins going into there, maybe a big chunk, maybe there's 10,000 Bitcoins going in there, and a whole bunch of OGs putting 1,000 in each. They're just rotating into an equity wrapper, and that looks like they're selling. Okay. There could be also quantum fears. So those old addresses need to be rotated into the latest Taproot addresses to be more quantum safe. So they could be doing that as well, right? So and custody rotations, maybe putting in institutional custody. A lot of whales are now putting their coins in with the bank so they can borrow at TradFi rates. So all of those things don't mean a sell. It means that they've moved those coins, so it may look like a sell, and we might be picking up the wrong signal there. We're just correlating it to why is everything so flat, but we don't know the exact truth.
But we look more broadly, right? So those net effects tend to, I think, be more stable. We're not looking specific, right? If you were like more of an Anson type of analysis, we would have to be super careful. I'm fully with you.
Mm-hmm. Yeah. Though these are very, very broad sweeping, like quantum resistance. Like there's going to be a lot of addresses going to move there, and we've seen correlations where the Google compute make new breakthroughs on the quantum, and we saw a spike in rotations of addresses. So that is real as well. So yeah.
What impact do synthetic Bitcoin products like ETFs have on Bitcoin usual supply, demand, and price behavior? It probably stretches things out, right? Everything becomes more of a TWAP type of situation. So less likely to have massive single selling points or single selling events that are it tends to kind of average things out. But yeah, it's hard to say so, right? We're still in the process of learning what sort of impact that has on Bitcoin. You can use other ETF situations like gold's ETF in the 80s, I think, to see what sort of effect that had. It obviously, it makes it more range bound, it feels like, right? So the massive extreme upsides and the massive extreme downsides tend to be more capped. That's the feeling that I get. What do you think, Willy?
Not much further to add, really. I just wish we can move quickly through the questions.
What do you guys think about the bearish cross MACD? I think it aligns with what Henrik and Willy were saying before, that we have a bearish divergence. I think there is bearish structure coming in that has been persistent now for many, many months.
A long time.
Henrik, yeah. Henrik, do you agree that speed of the move up also matters a lot, as the markets are very much driven on sentiment and FOMO? It activates retail investors to push their money in. Absolutely. So the guys that have now left the market and have gone to trade stocks, they're going to come flooding back in. And that's exactly kind of how that alignment and culmination event happened.
And that's what I tried but trying to say also when we on the video I did the other day for free for everybody on Twitter, just to say, guys, there will be a lot of people now being all feared up, and a lot of people will come FOMOing in, and especially when the narrative shifts and now crypto is everything, Bitcoin is everything, you'll see a lot of people be rushing in and they're going to burn their fingers. So this is why we need to understand where we are sentiment wise. And yes, I think a lot of FOMO was going to drive a lot of this market here. Yeah.
Yeah. In terms of the downside, so once you do get a correction 26, DCAing, I mean, yeah, it always depends on the window, depends on when. If you start DCAing once, let's say Bitcoin is 90% down, very different than if you do it on the way down, right? So quite an open-ended question. I would say that you'd want the dollar to start showing signs of a reversal before you would start getting back into a Bitcoin type of position, especially if you are in a balance sheet or in a solvency type of situation, right? Or solvency based recession. Will there be a replay link available? Yes, we'll send it out. Whoever signed up to this webinar will get an email on Tuesday with the actual recording. I hear you talking mostly about the United States, BTCs worldwide. What is going on in the rest of the world, or is it that not important for the BTC price? It's liquidity. So dollar is the dominant actor in that theater. So if the dollar starts moving in the opposite direction in a strong way, it doesn't matter. You're going to feel it everywhere. Any currency versus the dollar is gonna depreciate.
Yeah. Also, there's a point that, like, when you were tracking M2, you're actually tracking dollar because it's measured in US dollars. So if the strength of the dollar exchange rate changes, and it suddenly becomes very strong, that means all the other M2s in different currencies, Chinese yuan, that starts to drop and collapse. And so M2 looks like it's collapsing, just because the FX rate. There's, what is it? Is it one fifth, one quarter of the actual fiat is US dollars, but it's all measured against the strength of the dollar relative to others. So M2 is kind of a bad metric because it's all these ratios messing with each other. Dixie is much better.
100%. Before we end the webinar, I just wanted to mention there's also going to be quite a few updates that we're going to be presenting in the vectors. So we've now had about 4 months since the release date, and now we're going to come through with massive updates on impulses, on narratives. We're going to be aggregating things together, making it a lot more intuitive, a lot more broad-based, so you can actually start understanding how these things interlink with each other. Then that's going to be very, very nice to see. So for those of you that haven't looked at the vectors, you can look at it on our website directly on swissblock.net / products. We'll have all the suite there. So this is going to happen within the next 2 weeks. So yeah, expect updates,
and also,
big updates.
I just want to say on that there are times where macro is very boring because it's liquidity driving things, but there are also times when macro starts to drive. And I will say that this is the time. If you want to follow macro, then tune into our Zeberg letter and follow me there on where I lay out everything on my business cycle and everything, and on a monthly basis, and also give you ideas of directions and stretches in terms of equities, bitcoins, and so on and so forth. Trying to understand when we really see the shit hitting the fan, and it's also but also on the positive side, again, because it's all negative. It's not just going to be all negative. When will it then be time to get back into the water? That is also what the business cycle model will help us tell. And when we get the force which is strong enough, and there will be nice opportunities to buy, great companies or whatever it will be, at that time. So take a look at it, because right now macro is going to be very important. This is the fun time for a macroeconomist like myself.
Absolutely. Thanks a lot, guys.
Thank you.
Thanks, guys.
Thank you.
All right.